Who was expecting that the Central Bank of Nigeria would raise interest rates at a time that the world basically is talking about cutting rates? I bet you no one did, except of course members of the CBN's Monetary Policy Committee. What most analysts expected was that the central bank would at least hold interest rates steady at 26.75%. But what the central bank did last week was the exact opposite. The central bank came out and cut interest rate and raised interest rate by 50 basis points. I mean, this was a shocker for almost everyone, both locally and internationally. Of course, the central bank had its reason for raising interest rate, but that decision has impact on you, your investment, the economy, and the capital market as a whole. Now, on this episode, I'm going to cut through all of this as we progress. Also, within the week, we had news from EcoBank launching a 5-year dollar-denominated note. Access Bank also published their half-year report last week. And of course, on the show the previous week, I spoke about Costco, one of the leading retailers in the United States. They came out with their Q4 earnings report last week. So on this episode of Market Tape, I'm going to run us through all of that. Good morning, welcome to a brand new episode of Market Tape. This is the show you never want to miss, because I do this every Monday morning to bring you up to speed with not just the Nigerian capital market, but in fact the global capital markets. So you want to be sure that you are subscribed to this show. As a disclaimer always, this show is essentially for information purpose. Nothing said or insight shared on this show should be construed as an investment advice. Investing comes with different degrees of risk. Some has to do with you and others with just the general market risk. This show has not considered any of this in putting out the information that I put out. So you just treat it as just for information purpose. If you want to use any of the insights that I share on this show, make sure to run it by your investment advisor to make sure you're doing the right thing. For details of disclaimers and disclosure information about me and members of my crew, go to the description segment of all our social media platforms and our podcast channels. Go to all the description segment and you have all of the disclaimers and disclosure information that you need to know. Going through this will help you evaluate the objectivity of what I say and the information that I share on this show. So today, matter of the day, the central bank raising interest rate by 50 basis points. So basically, we are at 27.25% in terms of the monetary policy rate. The monetary policy rate is the rate at which the central bank lends money to other banks. So with that rate reaching an all-time high of 27.25%, what it means now is that your banks will borrow money at 27.25%, meaning that no bank will lend to you at less than 27.25. I'm sure that for people who have loans from the bank, business loans, personal loans, the banks would have already mailed you, notifying you that rates have gone higher. Basically, I think rates for most banks is well over 30% as of today. So what the CBN has done is to raise that rate. And this decision by the central bank comes with a lot of implications. First of all, for businesses, I already alluded to how it affects individuals, the fact that you now borrow at a much higher rate. Now, for businesses have been groaning for quite some time. We've heard complaints from businesses. I think about 2 months ago, we heard the richest man in Africa complaining that at 30%, no economy can grow at 30%, and that no one can create jobs at an interest rate of 30%. So what the CBN has done is to keep rates even higher than 30% on the commercial side. So what it means is that it's even harder times for businesses, and especially businesses in manufacturing businesses, consumer goods, and all of that. So basically, if you are not a commercial bank, I'll get to that later on this show. If you are not a bank that has access to depositors' funds, you're going to have a hard time going forward. So that is that on the business side. For investors, it's a different ball game entirely. I'll get to that as the show progresses. But basically, it's a tough time for us, for the economy too. Most Nigerians live well below poverty line, and high interest rates will not do us any good in terms of improving on the standard of living for majority of the citizens in Nigeria. But obviously, the central bank had its reasons for raising interest rates. So, but whatever the reason is, you're going to see negative impact on businesses, especially manufacturing businesses. Anyone who needs to borrow money from the bank would have a hard time with this rate at such record levels. And then for the economy in general, you're going to see what the CBN is doing basically is sacrificing growth for price stability. That's what the CBN has done basically. So the CBN is saying we know that the economy may grow at a slower pace. Already in the past 10 years, the GDP growth rate for the country has kind of been nothing to write home about. Basically around 2-3%, and sometimes it drifts into negative territory and then comes back up. Currently, it's around 3%. For a developing economy, you can't be growing at 3% and have meaningful impact on the economy. That cannot work in any developing economy. So the economy needs to be growing at least 6%. But with the central bank raising rates to 27.25%, what they are basically doing is sacrificing economic growth for price stability. And then, of course, unemployment. We saw unemployment figure come out for Q1. I think it came out to 5.3%. That figure may be worse at the end of this quarter, because if you have rate at 27.25%, we expected that rates will at least remain where it is or even drop by maybe 50 basis points. But now it's much higher. So businesses would struggle to stay afloat. And one of the adjustments that businesses may make will be to cut down on their staff strength. So which may increase unemployment rate higher than the 5.3% we saw in Q1 2024. So negative implications for the economy, but obviously the CBN had its reason for raising rate, and I will get into this. One of the reasons that was put out by the central bank was that they needed to strengthen the recent disinflationary trend and manage inflation expectations. So you saw inflation come down to 32.14% from 33.4% in July, came down to 32.14% in August. What the CBN is thinking is that this current decline in inflation or slowdown in inflation rate is not sustainable, and it's true. It's true because you have to understand what accounted for the disinflationary pressure. Now we're in the harvest season, and food inflation has been what has been driving inflation for a long time now. So food prices came down a bit. So the central bank is saying that, yeah, we are aware that this is the harvest season, and after this, food inflation may reverse again and start to put pressure on the consumer inflation. And then again, we're still in the process of discovering the price of petrol price. We are still in the discovery process. We don't know what the final price of petrol will be yet with the coming up of the Dangote refinery, and talks about ending subsidy, whether we are ending subsidy or not ending subsidy. So these conversations are still being had, and the CBN expects, in my opinion, that petrol price may inch higher a bit. And with petrol price going higher, it's going to put more pressure on inflation. And so for them, in order to ensure that they are not taking things for granted, they are not overestimating the impact of the current disinflationary pressure, they decided to raise rates just to be on the safe side. And then the other reason is to stabilize the naira and then narrow the negative real rate of return. Obviously, we've seen some success on the part of central bank in stabilizing the exchange rate. The exchange rate has basically been between 1,005 to 16 in the official market. I think it got to 1,650. So again, the CBN is not very confident on the current stability that we are seeing. Obviously the pressure is still there, especially on the demand side, and then of course the supply side. Most of the inflows we've seen have come from intervention from multilateral institutions that the central bank has or the federal government has reached out to in terms of increasing FX supply. So on the real supply side, by real I mean in terms of increasing foreign exchange through exports, we haven't seen much improvement here, and I think that is what is worrisome at this point, particularly from the central bank. Well, you can't sustain your FX intervention through borrowing, and as of today, the central bank is still intervening in that market. So they are not very confident in terms of the stability of the naira. So for this reason, the central bank and the MPC members see raising rate as the only way out. You must feel for the central bank. This is the only tool they have, to make an impact in terms of price stability. Exchange rate is basically the only tool they have. And we've had discussion about what the monetary side of what the fiscal side of the equation needs to do to help the central bank. I mean, that is the subject for another day. Then to the third reason, which is to narrow the negative real rate of return. As we well know, inflation is at 32.14%. And with most money market instruments around 20%, you still have a wide gap between the inflation rate and the current interest rate environment in the whether it's the treasury bill market or the bond market. 2 weeks ago at the auction before the one we had last week, the closing rate for the 1-year treasury bill closed at 18.59%, which is well below inflation rate at 32%. So if you're investing in treasury bill and inflation is at 32.14%, you are getting a negative return, because the return you are getting from the market would not even cover what you are losing to inflation. Same with even the stock market. Stock market return, I think, is around 31 point something percent currently. I think around 31.4% or thereabout year to date. That is still below inflation rate. So no one is getting a positive rate of return in Nigeria. And for the central bank, this is important. For you to keep attracting foreign investors, which is the target for them, your real rate of return has to be positive. And this also informed their decision. So for your investment, how does this impact your investment? Obviously, for people who are investing in the stock market, what I see happening is that you at some point, we expected that when rate starts coming down, you start to see funds flow from the fixed income market to the stock market again. But that may not be happening anytime soon. In fact, You may even see some money leaving the stock market and going out to the fixed income market. But of course, there are companies that may be positioned to benefit from this. And this is where you speak of the banking stocks. The banks are sitting on a pile of cash. And for any institution sitting on a pile of cash today, what you simply need to do is to deploy that cash into fixed income securities. The banks don't even need to create loans. I understand that the CBN also raised the CRR, which is the cash reserve ratio. So for every deposit the bank takes, a portion of the deposit must be kept with the central bank. So they raised that rate from 45% to 50%, meaning that for every deposit the bank takes, they now need to place 50% of it with the central bank. The remaining 50%, they can either create loans with it or invest in the capital market. So for a bank, most of these banks are sitting on trillions of naira. We saw the result of Access Bank last week, which I would say was kind of underwhelming. If you have seen what GTB did with less assets, with less customers' deposits, and then you place that side by side with what Access Bank did, I feel like the performance by Access Bank was a bit underwhelming. But then Access Bank has customers' deposit over 20 trillion naira in customers' deposit. So if they have access to 50% of that, that is still 10 trillion. Imagine investing, let's say, 70% of that 10 trillion or even 50% of that 10 trillion at 25%. The outcome will be crazy for these banks. So obviously the banks are sitting on a pile of cash and they are well positioned to benefit from this whole high interest rate environment. About 2 episodes ago, I was speaking about the banks and their prospect, especially in the light that many of them are recapitalizing. To be honest, I haven't been very bullish on these banks. But with this current environment, I think one has to look at their portfolio again and see if some of these banks will be worth adding to portfolios. But obviously, if you are invested in the Nigerian stock market and you are looking at the manufacturing sector, industrial goods, consumer goods, and even oil and gas, you may want to look again and focus on companies that have a high amount of cash, companies that don't need to go out borrowing. That should be your focus if you're looking at the Nigerian stock market. And then again, companies that can pass inflationary costs to their consumers. So basically people operating in a monopoly or a near monopoly. Those are the kind of companies that I see may do well in this interest rate environment. But on the fixed income side, it's a party for people investing in that market. It's a big time party for companies investing in the fixed income market. Treasury bill 2 weeks ago closed at 18.59, but after the rate hike, we saw that go back to 20%, back up to 20%. Even the bond market, average bond yields went up again last week. I'm currently at about 18.7%. This morning on the 10-year instrument, I'm seeing the yields back up to 21% on the bond side of things. So it's a delight for investors in the fixed income space. And I know I was speaking recently about the fact that we should expect that interest rates will start to come down and moderate. But obviously that is not what is going on at the moment. And it speaks to how uncertain these predictions that we sit up here and do can be. We can all sit down here and postulate and make expectations, but ultimately there are people who are in charge of making the ultimate policies, and they have more information than us most times, and sometimes arguably they may make mistakes or present policies that doesn't align with every other person. So it's the reality of the market, and we just have to find a way to always adjust as we get this information. So moving on to EcoBank. EcoBank recently announced the launch of a USD denominated benchmark 5-year senior unsecured notes. Okay, so I'm going to read this one. It was a brief information put out by EcoBank on Friday. EcoBank Transnational Incorporated, a leading Pan-African banking group with presence in 35 African countries and rated B stable by S&P and B stable by Fitch and B3 negative by Moody, has mandated ABSA, AFC, that is African Finance Corporation, African Export-Import Bank, Mashreq, and Standard Chartered Bank as joint lead managers and joint book runners, and Renaissance Capital as financial advisors, to organize a global investors call, as well as a series of fixed investor calls and meetings commencing on Monday, 30 September 2024. A 144A Reg USD denominated benchmark 5 years senior unsecured note offering will follow, subject to market conditions. The notes are expected to be rated B by S&P and B3 by Moody. And then at the end of this, there's an important note that says, this announcement does not contain or constitute an offer or solicitation of a buy or solicitation of an offer to buy or subscribe for securities to any person in which such offer or solicitation is unlawful. The securities referred to in this press release have not been and will not be registered under the regulations in Nigeria, Ghana, and UEMOA, and may not be offered or sold in this region. So, to just summarize, what EcoBank is saying is that they're about to borrow more money in USD in 5 years maturity. They put out this from their headquarters in Lomé, Togo, on Friday. That is the summary of this. Obviously, a lot of you guys there already have investment in EcoBank Eurobond, the existing dollar notes that they have running in the market. They had the $500 million that matured earlier this year in April. So I think they are basically trying to refinance that issue that matured earlier this year. So the bank borrowing more money has implication because it's going to obviously impact their ability to pay back on even the existing debt. So we have to sit back and evaluate whether this impact will be material or not. Certainly, I'm going to dig deep into that and come up with an opinion going forward. But just to keep you informed that EcoBank is about to borrow more money. So EcoBank operates in about 35 African countries, and they earn most of their revenue in dollars actually. So of all the corporates that have borrowed in naira, EcoBank is one of the corporates that have a more stable source of revenue in the currency they have borrowed. So just something for us to stay abreast with. Now to the foreign market, we saw the US market return. The return wasn't very impressive last week, but by and large, we are at the end of September, and September is supposed to be one of the worst months historically for the stock market. But this September, what we've seen is that the S&P 500 as of Friday doing 2.61%, and the Nasdaq, the tech-heavy Nasdaq, doing 3.44%, which is impressive considering the fact that we expected September to be a bloody month for the stock market. But obviously, with the US Fed cutting rates, and then the US economy staying as strong as it's been for a while now, the market is actually thriving on artificial intelligence and all the innovations that have come with that. So basically the tech sector has been driving the market all month long. Now on the show last week, I did speak about Costco. Costco is one of the biggest retailers in the United States, and they presented their fourth quarter report last week. By some standard, that report was not very, very impressive, and but by other standards, the market, some investors were quite impressed with what Costco did. So just to show you the numbers, Costco in Q4 2024 posted a revenue of $79.69 billion against an expected revenue of $79.9 billion, just slightly lower than expected. Earnings per share was where the company beat expectation. EPS came at 5.29 per share compared to 5.08 expected. So what is going on here is we know gasoline price. So Costco is a retailer that operates about 614 warehouses in the US and another over 200, I think about 277 warehouses internationally in countries like Canada, Japan, and I think Mexico, United Kingdom, Puerto Rico, and all of those countries. So they run this warehouse model where if you go to a Costco warehouse, you can buy virtually everything. You can buy gasoline for your car, you can buy gold, you can buy cosmetics, wares. In fact, they have their branded merchandise trading under the brand name Cockland. So this is what they do. Overall, I think the company is still trending in the right direction, if you ask me. Membership fees went up from 1.509 billion the previous year to 1.512 billion currently. I mean, the Costco recently raised their membership fee by $5, and membership fee is a very important part of their strategy overall. So what they do is that you pay a membership fee to get all the discount that Costco has to offer, and their pricing is such that you get deep discount to the point where you may not get it cheaper, or it's difficult for other competitors to match the prices you get at Costco. So it's a very important part of what they do overall in terms of their strategy, membership fee. And then it's also on record that they have a very high retention capacity. So I think about 92% of their membership gets renewed annually, and that is very, very high. Also, their e-commerce revenue grew by 18.9%. Costco has not been the name that everyone talks about when it comes to e-commerce, but slowly, I think they are ramping up the contribution from that segment in terms of their overall revenue. And then the other interesting thing is the average age of their members. So I think their members are getting younger. Based on the earnings call, 50% of new members are under the age of 40. So you would assume that such membership program will appeal to older shoppers a lot more. But I think the company's strategy is now resonating with younger people, especially younger families. And where I see growth opportunity for Costco is the fact that they just have 614 warehouses in the whole of the United States. I think they have the capacity to even double that number. But obviously they have their strategy, and the rate of growth in their warehouses is not, for me, is not very rapid. And I think it means opportunities in terms of the fact that they can easily double these numbers to over 1,000 if that fits into their overall strategy. So overall, many people are going to look at the price of the current company price and wonder if it's not too expensive. I think the price is around just below $900. And Costco is one company that has always been expensive, in my opinion. I remember when I first, bought their shares, it was around 400 and something, about just over $400. And I considered it expensive then. But for a stable company that has been growing revenue steadily, not at a very high pace, but at a steady pace, and that has one of the best retailing strategy in the world, I think the company that is going to always stay expensive, in my opinion. It will always be expensive. You're not going to see Costco fall from 900 to 300 suddenly, as you see with technology stocks and all of those volatile stocks in the market. So it's a very stable company. Earnings have been growing stable. Earnings have been growing with a good stability over the years, and then there are also growth opportunities in terms of the fact that they can increase the number of stores that they have. They are also seeing younger families as members, and they also have this high retention in terms of people renewing their membership annually. So overall, I think it's a good company for conservative investors. Obviously, if you are an investor who wants high growth companies, this may not be the company for you. But if you're an investor who wants a company that is growing slowly with less risk, less volatility, then Costco is one that you may consider adding to your portfolio at some point. And this is where I bring it to an end on this episode of Market Tip. Thank you for listening. Make sure you subscribe so you never get to miss any of my shows. Thank you. Till next week, I'll be back.